Every time prices rise, freedom shrinks. But for some, profit expands. You don't see it when you swipe your card or when you check your paycheck. But every increase, every adjustment, every quiet percentage point moves wealth a little higher up the ladder. The system doesn't shout while it takes. It whispers through interest rates, through markets, through policies you never voted for. And by the time you feel it, the transfer's already done. Because inflation isn't chaos. It's control. If you've noticed your paycheck stretching thinner every month, you're not crazy. Groceries, rent, and gas inch upward like a silent tax no one voted for. Behind every price tag hides a story, one written by policy, not just markets. Most people call it inflation. Economists call it necessary. But to the few who truly understand it, inflation is the most elegant heist ever engineered. It doesn't need thieves, guns, or panic. Just time. Every decade, the same magic trick repeats. Money loses value, yet those who already have plenty somehow end up with more. It's not luck, it's design. We were taught that rising prices mean a strong economy, that wages follow prices, that progress has a cost. But look closer, and you'll see that inflation is less about things becoming expensive and more about value being siphoned from labor to capital. Inflation feels chaotic, prices out of control, savings eroding, futures shrinking. But to those steering the machine, it's perfect order. Because when prices rise, debt becomes cheaper to repay. When debt becomes cheaper, governments, corporations, and the wealthy all win. The ordinary worker, they're holding money that melts a little more each day. The elite, they're holding assets that inflate faster than the currency decays. It's the same phenomenon that keeps power cycling upward, an invisible treadmill where everyone runs, but only a few move forward. And here's the secret most never learn. Inflation doesn't destroy wealth, it rearranges it. It decides who owns the future and who merely rents it. For governments, inflation is a tool, a way to pay for wars and bailouts without ever asking permission. For corporations, it's a solvent, washing away debts while stock values rise. For the rich, it's strategy, because they hold the only things inflation can't touch: assets. But it wasn't always this way. There was a time when inflation was seen as a national emergency, not economic policy. When money meant something tangible, something you could hold, not just believe in. And to understand how the rules flipped, we need to go back to when the world's currencies were chained to gold, and governments couldn't print their way out of bad decisions. Once, every dollar was more than a number. It was a promise backed by gold, by scarcity, by restraint. Every paper note was a claim to something real, sitting somewhere in a vault, guarded and finite. This system wasn't built on trust. It was built on limits. Governments couldn't conjure money out of thin air. Banks couldn't multiply credit infinitely. If you wanted to spend, you had to earn, or raise taxes and face your citizens. It was an age when money held its breath. But scarcity has enemies: war, depression, ambition. They demand flexibility. When economies froze in the Great Depression, prices didn't rise, they fell. Wages collapsed, factories closed. People stopped spending, not because they didn't want to, but because every dollar tomorrow was worth more than today. It was deflation, the mirror opposite of inflation, and it terrified policymakers. Money gained value while society lost it. Governments realized that the world could die of stability just as easily as chaos. And so began the Great Reversal. The idea that controlled inflation wasn't the problem. It was the cure. The shift was subtle but revolutionary. The new mission wasn't to protect the value of money, but to preserve the motion of it. A frozen economy was seen as death, constant expansion as life. When the Second World War ended, nations were buried under debt taller than their cities. To pay it back honestly would have taken generations. So instead, they discovered a quieter method. They let inflation melt it away. By the 1950s and 60s, debts shrank not through repayment, but through time. The numbers stayed the same, the value didn't. Governments learned that moderate inflation could solve impossible problems. Without riots, without votes, without headlines. Inflation became a political anesthetic, numbing the pain of debt while keeping the machine running. And just when the world began to believe this balancing act could last forever, one man broke the final chain. In 1971, the world's financial order quietly rewrote itself. It happened with a single televised address. President Richard Nixon closed the gold window, ending the dollar's convertibility to gold. It was meant to be temporary. It became permanent. In that moment, money stopped being a measure of value and became a tool of policy. The dollar, once a certificate of stored wealth, became an instrument of faith. You could no longer exchange it for gold, only for more dollars. The system had shifted from substance to confidence. For the first time in modern history, the world's dominant currency was backed not by metal, but by belief. Inflation wasn't a side effect anymore. It was the design. Governments could borrow endlessly. Banks could create credit without restraint. And as long as the public believed, as long as people kept trading, spending, and saving in dollars, the illusion would hold. But illusions have consequences. Every new dollar printed diluted the old ones in your wallet. Every rescue, every stimulus, every bailout was paid not with taxes, but with time, your labor, your savings. It was the birth of managed inflation, a system where stability was defined not by truth, but by control. Investors quickly adapted. They realized that in this new world, saving was for the naive, borrowing was for the wise, because inflation, that invisible tide, would quietly repay your debts for you. $1 million loan today would feel like a burden, but in 20 years, after steady inflation, it would feel like a feather. The game had changed forever. If you owned, you won. If you saved, you lost. And this new reality created a generation of quiet winners. People who didn't just survive inflation, they engineered it. The rich don't fear inflation. They own it. They've learned to treat every price surge as a ladder, not a wall. While ordinary people panic over groceries, they're calculating compound appreciation. When money loses value, their assets rise, their debts shrink, and their portfolios multiply. Because inflation flips the logic of money. Cash decays, debt dissolves, assets ascend. If you're a wage earner, your income lags behind the rising tide. But if you're an investor, the same tide lifts your ships higher. And this isn't conspiracy, it's arithmetic. Every year of steady inflation lightens old debts. A loan once suffocating becomes manageable. A mortgage transforms from shackle to strategy. That's why the wealthy embrace leverage. They borrow in weak money to buy strong assets. Real estate, stocks, art, land, all things that rise faster than the currency falls. Meanwhile, the saver, the person told to be responsible, is punished. A 3% bank yield versus 6% inflation isn't profit, it's erosion in disguise. Saving becomes a slow-motion loss. Inflation doesn't reward virtue, it rewards velocity. Those who move capital faster than money decays win. The rest, they work harder each year to stand still. This is the hidden syllabus of capitalism, one that was never taught in schools. Inflation isn't merely tolerated, it's cultivated. It is the lifeblood of a debt-based world. Without it, borrowers collapse, banks seize, and governments face truth. So the system quietly agrees. Better a soft theft each year than an honest reckoning once. And those who learn that truth early become the architects of the modern era, the alchemists of credit. In the 21st century, creation of money no longer requires printing presses, only keyboards. When central banks buy government bonds, they conjure liquidity out of electrons. The term sounds harmless, quantitative easing, but behind it hides the largest wealth transfer in human history. Trillions flow not to citizens, but to financial institutions. The stock market revives overnight. Wages do not. Assets soar, and so does inequality. Those who own see exponential recovery. Those who rent wait. Inflation of prices gets headlines. Inflation of assets rewrites society. From 2008 to 2020, every crisis was solved the same way. Print, inject, repeat. It kept the machine alive, but hollowed its foundation. Then came 2020. A pandemic froze supply chains, while governments flooded citizens with emergency money. Demand exploded. Goods vanished. Prices surged higher than at any point in 40 years. Once again, the rich were ready. They owned scarcity itself. Real estate, stocks, commodities, the very things inflation rewards. For the bottom 90%, it was déjà vu with a cruel twist, higher costs, stagnant pay, and a market that sprinted ahead of reach. For the top 10%, it was acceleration. Quantitative easing didn't rescue the economy, it repriced it. We built a world where debt is fuel, not burden, and the fire can never stop burning. Because without constant expansion, the illusion collapses. Inflation became culture. It teaches consumption, not patience, speculation, not prudence. It shapes a citizen who must always chase. That chase feeds the lenders, the markets, the empire of endless growth. Here lies the final paradox. Inflation keeps civilization breathing, even as it drains its soul. Deflation would crash banks, freeze credit, expose fragility. Inflation hides the cracks, smooths the panic, and moves the pain downward. It's not villainy, it's maintenance. A small price, they say, for stability. But stability for whom? Every year, the purchasing power of the working class erodes a little more. Their labor buys less, their savings dissolve faster. Meanwhile, the asset holders, the few who live ahead of time, see their wealth amplified. Inflation rewards those who borrow from the future and punishes those who live within their means. It converts patience into penalty, prudence into poverty. And yet the system can't survive without it. Because the alternative isn't justice, it's collapse. So policymakers perform their ritual. Raise rates, talk tough, then relent before the structure buckles. They call it fighting inflation. In truth, it's choreography, a dance between credibility and necessity. Deep down, everyone at the top knows the secret. A little inflation is the cost of keeping the illusion alive. But for the millions at the bottom, that illusion is rent due, groceries unpaid, futures postponed. Inflation is not the fire, it is the oxygen, and the world we built can't breathe without it. Once you see the pattern, you can't unsee it. Inflation isn't random. It's how power measures time. It decides who gains, who loses, and who gets forgotten. So the next time someone says a little inflation is healthy, ask, healthy for whom? Because in the end, money doesn't just buy things. It buys silence. And the quietest theft in history continues, 1 percentage point at a time. If this changed how you see the world, remember, history always leaves clues. You just have to follow the money. This is MoneyLore Insider, where finance meets mystery. Subscribe for the stories they don't teach in economics class.